You have limited upside, you're capping your upside, but you still have risk all the way to zero when you're doing a covered call. And this is why I want to point out the major differentiator between the covered call and the collar. So what I want to discuss is the covered call versus the collar strategy. A number of you heard me mention recently that I think that the collar strategy is better than the covered call. And that can just be my opinion, and that's fine to have that opinion, right? If you have a different one, that's fine that you have a different one. Most people have heard of the covered call, and that's been definitely the winner across the markets sentiment wise. And the reason why is because most people do not like to pay for things. We don't want to buy or spend money on things. And when you buy puts, it feels like you are throwing money away because the market has a tendency to drift up and you feel like you could have made more money. You don't want to buy puts. And I can understand that sentiment. But let's break down the two different strategies and let's see if I can convince you otherwise that the collar strategy is better than the covered call. We're going to start off by doing the covered call so you can see the kind of dynamics. I know you already know that one probably, but I need to compare it to the collar. So we'll start off talking about the covered call. We'll do it briefly. So we're going to go to this 30 days. You can use it at any time frame. You guys know we've been doing a lot of 7-day trades or a weekly type of trade with our safeguard strategy. So when you're going to do a covered call, you're going to buy 100 shares and then you're going to sell the call. So let's just say you're going to sell the call at this 26 delta here with the TLT. When you sell a covered call, you are limiting your upside potential. I like to call the covered call strategy the landlord strategy because your 100 shares that you have represent the house, represents property. It represents an asset that you can rent out and make some weekly or monthly or quarterly type of income off. You become the landlord and you are allowing someone to rent to own your shares, just like you can rent to own a house. And if you create a contract, which an option is, it's a contract, you're giving someone, the buyer of the option that you create, you're giving that person the right, but not the obligation to purchase your shares at a strike price. They do not have the right to purchase it at any other strike price, only the one that's associated with the contract. In this example, the 89 strike. So they have to pay you some monies for that contract, just like if you were creating or getting a contract with the insurance company, like a Geico. You have to pay them money for them to be able to insure your house, your car, your motorcycle, whatever the case may be. You have to pay them some premium for that. And that's the same thing as happening in an open market. Someone's paying you premium. In this example, someone's paying you $59 to sell the 89 call to them. If the stock goes all the way up to 95, you do not win anymore. You don't win another $6 or $600. You stop winning at the 89 strike. So you're limiting your upside. What the covered call does is give you an income type of play. And on top of that, it hedges you some to the downside, depending on how much credit you receive. So this $58, $59 that you receive, this is the credit. This is the income play that you can have for renting out your shares, renting out your house. But it also protects you to the downside. So in this example, it's going to protect you 58 cents to the downside. So instead of your cost basis being 86.55, as you can see right here, that's your cost basis. If you were to buy the shares outright at the 86.55, your cost base is actually lower than that at the 85.97. So 59 cents, 58 cents less. It lowers your cost basis at the very least. What does cost basis mean? Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. Cost basis means the money you have in the trade, the amount you had to pay to be in the trade, or the amount of risk that you have in the trade. That's your cost basis. So if I go out and buy some shares right now at 86.55, that is my cost basis. If the stock goes up past that, my cost basis is less, so I have a profit because I can sell it for higher. If the stock goes below that, now I have a loss because I I can't sell it for higher. Cost basis is what you've put into the trade, your risk in the trade. So as you can see, as I pointed out here, your cost basis was 85.97. It's saying 8,600 right here. That's how you can know your cost basis. But this is also your max loss if the stock goes to zero. If you're doing the safeguard strategy the way we teach here at Dorian Trader, you should have no ever have the possibility of the stock going to zero because you're doing it on indexes, you're doing it on things that can't go to zero or have darn near a 0% chance of going to zero. But that's technically your risk is all the way to zero when you're doing a covered call. You have limited upside, you're capping your upside, but you still have risk all the way to zero when you're doing a covered call. This is why I want to point out the major differentiator between the covered call and the collar. It's this point right here. The covered call has risks all the way to zero. And sometimes when a stock falls a lot, it can feel like it went to zero because your cost basis, using that word again, your cost basis is so out of whack. You pay for it at 86.55. It's now trading at 65, right? So your cost basis is $20 out of whack. Sometimes it can be worse than that. Some of you saw that happen in April for Liberation Day. You saw that the cost basis was really out of whack if you didn't have a collar strategy on. This is, once again, the major difference. Let's break this down. I want you to keep an eye on this here. It's basically about $8,600. That's how much you have at risk the next 30 days. It's not going to go to zero, but that's how much you have at risk. If you do a collar strategy, which consists of the covered call, but instead of just keeping all the $59, $69 that you receive for selling that covered call, you take some of those monies and you buy a put. So a collar strategy is just adding a put to the covered call, but you're doing it for free because someone's paying you first for the call you sell. You take some of those monies and you buy a put for that amount or less. So in this example here, let's say we bought the put at the 83 strike. Once we do that, we're still collecting, based on the options part of this collar, we're still collecting $26. We still have a good amount of upside. It hasn't changed too much because we're still at that 89. But look at the difference in your max potential loss over the next 30 days. We went from $8,600 in risk, and you can argue, okay, maybe it's not going to zero, and I can understand that. But what if it dropped 20 points? Any stock that you're on, that you're trading, what if it dropped 20 points? Well, that can be a $2,000 hit to your cost basis. In this example here, it's insignificant. The most you can lose over the next 30 days is $334. And if it did drop to 65, using that example again, that will be the most you lose, period, while you in the trade. You would actually lose less than that over time because you'll be able to continue to roll your put for a credit. You might not be able to add those calls anymore, but that's fine. You'll still be able to keep that protected put into perpetuity and get a credit each time it happens until the stock comes back. This is why I like the collar more because you can do a wide collar or you can do a tight collar. It can act more like a covered call, but still give you peace of mind that if something falls a lot, it's not going to wreck your cost basis. It's not going to cause you to take forever to get your monies back. So, for example, in this case, if I wanted to do a wide collar, I can literally go and put this at the 14 delta on the call side. And because I'm receiving about, let's just say, $26 on that call, I can buy something for less than that. So let's say I went to the 80 here. I still have some really good upside. It's trading at 86.61 now. If it jumps all the way up, I got all the way to the 91, which would give me max profit of 455. But if it drops a lot, the most I'm going to lose is 645 in this example. So I can do a wide collar or I can get real tight if I wanted to. If let's say I was initiating this collar and I decided, well, I didn't need a lot of money that I have to make over the next 30 days. You can do this for a week, but I just say for the 30 days, I can get real tight and do something like this, right? The most I can make in the next 30 days is 115. The most I can lose is 186. I can get even tighter and make the most I can make is 86. The most I can lose is 114. You can determine your risk level with the collar. This is why I love the collar. I don't dislike the covered call. I'm just saying in uncertain times, which we are currently in at really elevated levels because we don't know what's going to happen. It seems like every day, kind of state of affairs in the world. This is the difference between the covered call and the collar. The major difference. It's a few other differences, but this is what I want you to understand is that the collar can protect you a lot more. And so if you're a trader like me, I'd rather think about my risk first than what I can make. I've said that hopefully a ton of times on these calls that I think about what I can lose before what I can make. If you have that philosophy, you're going to be able to stay alive in this trading game. It kind of hinders you from getting too greedy because we're humans. We're always going to get greedy. But you have to have rules that you do not violate. And one of my rules that I do not violate is that I think about what I can lose before what I can make, because the trade is based on the shares. The shares is the foundation of the covered call and of the collar strategy. You're just going to have less overall risk with the collar strategy, but the collar strategy is bullish. Make no mistake about that, you guys. The collar strategy is bullish. All the four strategies that we do regarding the safeguard strategy is bullish. And the reason why we do that because the market has the tendency to drift up. So having an edge is being bullish, believe it or not. I mean, everyone has that edge that is bullish. The market does drift up, but you have a bigger edge than others because you know options. You know how to marry options to your shares. So my point, Andrew, is that put will gain in value, but it doesn't mean you're winning, you're making money overall. You're winning on that put and you're going to be winning on that call when you do a collar and it goes down. But overall, you're still going to be down. And so the reason why you're still going to be down is that, let me show you guys this. This is 100 shares. And I've mentioned this in the past, but I need to mention it more and more and more because we all need to hear things more than once. I know I do. If you have 100 shares, those each share equals one delta. So this is 100 deltas here. And then what happens if you buy a put, that equals negative deltas. So that's an 8 delta there. If you sell a call, that equals negative delta. So that's a 27 there. So I'm putting 27 here. And then if you add it all up, it's basically this that TastyTrade is telling you here. It's basically 65 deltas. 65 long deltas. You're still long, you're still bullish. So you're going to win on this, you're going to win on this, but you're losing on this. So you're going to overall lose. Not a lot, but you're still going to overall lose. You really want to lose on this, and win on the shares. That's where you get this type of money. That's where you get this. The shares are the foundation with the covered call and with the collar strategy. It's the shares, everyone. So if it jumps up and it jumps up a ton and it's at 100 and we put this trade on, it's at 100. Yes, we lost $11 of opportunity cost. It's not real money, but it's opportunity cost we've lost because it went from 89 to 100. We lost 11 possible dollars we could have won, or $1,100. But we didn't lose real money. We actually gained real money. $289 of real money. Don't be confused by what happened with the covered call or the collar. Most of us are confused about covered calls. We think we're doing well if that call expires worthless. You might be, but it doesn't mean you are. Most of the time, if that call expires worthless because of the shares actually dropping, you actually worse overall. If it goes up though, if your shares go up and then say this call spire is worthless, but the shares are now at 88, yeah, you've made some money. That's great. You made the money on your shares and you made money on that call. That's the ideal situation. And you just keep selling that call over and over and over, and it's never being sold away because the market is going up. Plus, your call is never being sold away. That's fantasy land. Eventually, your call will be threatened and sold away. If you do enough covered calls, it's going to happen. If you do enough collars, it's going to happen.